How is the global energy landscape transforming, really? And which companies are actually leading that charge?
Yeah, that's the big question.
Today, we're taking a deep dive into exactly that. We're focusing on a really critical player, GE Vernova.
Indeed. GE Vernova is, um, you know, squarely at the forefront of this accelerating energy transition. You find them involved in pretty much every step of the electricity journey.
Like generating it, moving it around.
Generating it, transferring it, orchestrating its flow, converting it, even storing it. It's a monumental task.
And their reach is huge, right?
No, staggering.
Yeah.
They actually power something like 25% of the world's electricity, a quarter of it.
Wow. Okay. So to really get our heads around the shifts happening there, we've dug into their latest earnings report, second quarter 2025, and the related financial stuff.
Right.
Our mission today is basically to filter through all that data, pull out the most important insights for you, understand, how they're performing right now, the strategic moves.
And what it all means for the future of energy.
Right?
Yeah.
Exactly. We'll be looking closely at their main segments, power, wind, electrification, plus their overall financial health and where they see things going.
So if you sort of connect this to the bigger picture, these Q2 results, they aren't just numbers on a page.
Yeah.
They show a company that's actively demonstrating pretty significant growth and strategic repositioning, and in a really dynamic market, too.
Right. And some of these initial numbers, they immediately jump out. Let's start with that financial health check for Q2. Orders were solid, $12.4 billion.
Which is, what, a 4% organic increase year over year?
Yeah, exactly. Which, indicates really strong demand, especially in power and electrification. It suggests they're capturing a surging market pretty well.
And what's really interesting here is the revenue. It soared to $9.1 billion. That's up 11% overall, and an impressive 12% organically.
And that growth wasn't just in one spot.
No, broad-based.
Yeah.
Across both selling new equipment and their, really vital services divisions.
Okay, and profitability, how did that look?
Adjusted EBITDA, that key measure of core operational profit, soared by an impressive 47% year over year.
47%.
Yeah, leading to an 8.5% adjusted EBITDA margin. Now, net income, that was $0.5 billion.
Which is actually a dip from last year, I saw.
It is, yeah. But here's the crucial context. That decrease isn't really a red flag about their core business. It's largely because last year included some, big one-off events.
Ah, right, like that arbitration payout.
Exactly, that big arbitration refund, and they sold off some nuclear assets. Those didn't happen again this year. So when you look past those unique items, their underlying operational health is actually looking incredibly robust.
Okay, that makes sense. So the underlying performance is clearly strong.
That's exactly right. And their backlog momentum is another really crucial indicator for, future performance, their total remaining performance obligation, or RPO, basically their committed order book.
Right.
It swelled by $5.2 billion
Yeah.
just sequentially, reaching a massive $128.7 billion.
Wow. So you can think of that as revenue that's basically locked in for years to come, gives them incredible stability, visibility into future earnings.
For sure.
That growing backlog reflecting high demand and disciplined underwriting, that's a really positive sign for future revenue and cash flow.
Positive free cash flow, $0.2 billion in Q2, which contributes to a healthy cash balance of $7.9 billion.
And they're not just hoarding it, are they?
No, definitely not.
Huh.
GE Vernova actually put $1.7 billion back into shareholders' pockets already this year, buybacks and dividends.
Okay.
It's definitely a strong financial position. And that's further affirmed by their credit ratings. Both S&P and Fitch didn't just affirm their investment-grade ratings.
They boosted the outlook.
They did. Critically, revised their outlooks to positive from stable during the quarter. That's a significant vote of confidence in their trajectory.
Okay, so strong foundation. What does this all mean for the individual segments then? Let's zoom into the engines driving this growth, starting with power that includes gas, nuclear, hydro, steam.
Right, and this segment delivered some incredibly impressive numbers. Orders surged by a massive 44% organically to $7.1 billion.
44%, mostly gas power.
Primarily driven by gas power equipment, yeah. That part nearly tripled. And revenues also increased a healthy 7%, or 9% organically, to $4.8 billion.
So the strength in gas power is just undeniable.
Totally. They signed 9 gigawatts of new gas equipment contracts just in Q2.
9 gigawatts, put that in perspective for us.
Well, 7 gigawatts went into what they call slot reservation agreements, SRAs. Think of those as like strategic placeholders for future projects.
Okay.
And 2 GW went directly into firm orders. Plus, they converted 3 GW of previous SRAs into firm orders while shipping out 5 GW of equipment.
So it's a complex floor, but they're managing it well. The equipment backlog stayed stable at 29 GW.
Right, but those SRAs, the placeholders, they actually grew from 21 GW to 25 GW.
Bring the total backlog in SRAs to a staggering 55 GW.
Exactly. And they think they'll hit at least 60 GW by the end of the year.
That clearly highlights, the strategic importance of higher turbine prices and just really strong demand in today's energy world.
And it's not just about new machines. Services growth is also robust. That's a sign of their sort of holistic approach to supporting that huge installed base they have.
Right.
Steam services orders were up 30%, mostly from nuclear extensions and critical upgrades, and hydro orders surged 61% for similar upgrade work.
What really fascinates me here, though, is the progress on small modular reactors, SMRs.
Oh yeah, that's definitely one to watch.
They're making tangible strides with their 300 milliAW SMRs. Construction actually started in Ontario.
Which is the very first project of its kind in the Western world. Huge milestone.
It really is. And beyond that, the Nuclear Regulatory Commission, the NRC, formally accepted TVA's application for the Clinch River site.
So basically that kicks off the whole formal licensing process, right?
Exactly. We should definitely expect more customer announcements on SMRs in the second half of the year.
That point actually brings up a really crucial consideration about the evolving role of gas power in a grid that's getting heavier on renewables.
How so?
Well, there's strong demand for these aeroderivative units, especially to support rapidly growing data centers.
The AI power crunch.
Pretty much. These units are attractive because they have faster commissioning times. Customers can bring power online quickly, and they can even price it at a premium for getting it fast.
So it vividly demonstrates how traditional power sources are adapting to critical new market needs.
Exactly, like the insatiable energy demands of AI and computing.
And to meet this rising demand, GE Vernova is actively ramping up production capacity at gas power.
The expectation is for at least 50% growth in upgrades by the end of the decade.
That's a significant outlook just for their existing fleet. Shows a long tail of value there.
Definitely. Okay, moving to electrification. This covers grid solutions, power conversion and storage, and software, basically, the whole nervous system of the grid.
Right. Now, orders here decreased 31% year over year. That sounds bad initially.
It does, but again, context is key. That's primarily because Q2 2024 had some exceptionally large sort of one-off orders that really skew the comparison. The underlying demand for grid equipment remained very strong.
Okay, that's vital context because revenues for electrification jumped a remarkable 23%.
Or 20% organically.
To $2.2 billion, led strongly by grid solutions. And the profitability improvement is, well, it's stunning.
It really is. Their segment EBITDA margin saw an extraordinary increase, 740 basis points, up to 14.6%.
Wow, how did they manage that?
Driven by higher volume, definitely, but also improved productivity and favorable pricing. So this isn't just growth, it's really profitable growth.
Okay.
And a particularly intriguing aspect is the backlog growth here, too. Equipment backlog grew an incremental $2 billion just in Q2.
And that's spread out geographically.
Yeah, North America, Europe, Asia backlogs in all those regions increased by almost 10% sequentially, which indicates pretty widespread and balanced demand for grid upgrades and expansion across key global markets.
They're also seeing an acceleration of demand in the Middle East, right? Particularly that announcement about Saudi grid stabilization equipment, those synchronous condensers.
Yes, that's a fascinating piece. So what does this all mean for you, the listener? These synchronous condensers, they act like massive shock absorbers for the grid.
Right, because when solar and wind power fluctuate.
Exactly. These powerful machines kick in to stabilize voltage and frequency, preventing disruptions. They basically enable the grid to handle far more of that intermittent renewable energy.
And this tech has been around, but now its time has come.
Pretty much. It's been manufactured for years, but the market is now truly catching up to its importance.
Yeah.
They're projecting like a $5 billion annual market opportunity.
Huge. And data centers again.
Oh, yeah. Similar to the power segment, data center demand is a huge driver here, too. Orders from data centers in just the first half of 2025 nearly matched the full year of 2024.
Get out the cure. What are the numbers?
Almost $500 million,
Right.
$0.5 billion versus $0.6 billion for all of 2024.
So this isn't just growth. It's an accelerating growth market. It's poised to really reshape power demand.
Absolutely. Now, they did acknowledge weaker European HVDC orders, high voltage direct current, due to some affordability challenges over there.
Okay.
But the momentum in other areas is more than making up for it. The company still expects the electrification equipment backlog to grow as much in 2025 as it did in 2023 and 2024 combined.
So it's still very strong growth overall.
Yes. And they're investing heavily in capacity expansion to meet it, up to $100 million in their Charleroi, Pennsylvania factory.
Creating what, 250 jobs?
Yep, 250 incremental jobs over 2 years,
Yeah.
and supporting a doubling of volume from 2025 to 2028. It really shows how their lean practices are identifying crucial new capacity needs.
Okay, let's shift gears to the wind segment. Onshore and offshore turbines and blades. This one sounded a bit more mixed.
It was, yeah, a more mixed performance here. Orders decreased 5% organically to $2.1 billion. That was primarily due to lower onshore wind equipment orders outside North America.
Okay, but revenues were up.
Revenues increased a healthy 9% to $2.2 billion, driven by higher onshore wind deliveries. So they're delivering more, but booking slightly fewer new orders internationally, at least in Q2.
But despite that revenue growth, the segment experienced EBITDA losses of $0.2 billion, and those losses actually increased year over year.
They did. And that was largely attributed to a couple things. Increased services costs, because they're working hard to improve the performance of their massive installed fleet in onshore wind.
Okay, so investment in reliability.
Exactly. And also the impact of tariffs on offshore wind. So those factors partially offset the gains they were making from selling more profitable onshore wind equipment. It sounds like, as you said, they're invested in future performance.
That seems like a key point, that investment in fleet performance.
It is. What's important here is that GE Vernova invested over $100 million specifically to improve the performance of its approximately 57,000 wind turbines out there in the installed base.
57,000 turbines.
It's huge. And that investment led to a 1 percentage point increase in fleet availability just since last year.
And that's not just about keeping customers happy, right?
No, it's strategic. It's freeing up capacity for more transactional work, more upgrades, more services revenue down the line.
And what about offshore wind? Still a challenging market generally, but how did they do?
Despite those persistent challenges, yeah, the segment actually had its most productive quarter to date in offshore. They installed 34 units and commissioned 33 units.
Okay, so execution is improving. And that massive Dogger Bank project?
Still ongoing. That's a significant undertaking, expected to be completed through April 2027.
You know, this specific development really highlights how policy can be such a powerful catalyst.
How so?
Well, that U.S. tax bill that was signed back on July 4th, they said it's already led to a tangible increase in customer engagement in the U.S.
Ah, interesting. Creating potential for maybe an inflection towards growth, as they put it.
Exactly. Though, permitting and getting grid connections, those interconnect queues, they remain crucial hurdles that still need addressing.
Always the practical challenges.
Yeah.
But they are seeing noteworthy wins internationally too, right?
Yeah, places like Romania, Australia, Japan, Spain, Germany, they're expecting more orders there in the second half of 2025. So the global appetite for wind is clearly still there.
Okay, so pulling back to look at the overarching strategic themes,
Yeah.
GE Vernova is clearly operating from a position of, well, financial strength.
Definitely. Ended Q2 with about $8 billion in cash. Generated positive free cash flow for the 6th quarter in a row.
That consistent cash generation provides a really strong foundation.
And their capital allocation seems strategic, too. They spent $1.6 billion on stock buybacks.
Repurchasing 5 million shares.
Right, showing confidence in their stock value. And they're making ongoing organic investments in the core business. But what really stands out to me here are those strategic acquisitions.
Yeah, what really catches my attention is the strategic foresight they seem to have with these deals. Buying Woodward's gas turbine parts business, that's a smart vertical integration move.
How does that help them?
It lets them optimize their big Greenville plant. They see a clear path to significantly increase labor hours there by 2028, driving efficiency and productivity right into the guts of the gas power supply chain.
Okay. And the Altea acquisition?
That one's scheduled to close August 1st. It's exciting because it brings advanced AI and visualization tech for grid management, and it's designed to immediately integrate with GE Vernova's own GridOS electrification software business.
So it's all about building a smarter grid.
Exactly.
And this all ties directly into their really deep-rooted focus on operational excellence and innovation, that lean culture focus.
Right. They continue to emphasize lean principles, eliminating waste, improving processes, reducing costs. It seems foundational to everything they're doing.
And then building on top of that lean foundation.
They're making these strategic shifts towards investing in robotics and automation, both in their factories like gas power, grid solutions, and even out in the field.
Like servicing remote wind turbines.
Exactly. But, and this is critical, they emphasize they're deploying these advanced technologies only after that strong, lean foundation is really established.
Which raises a really interesting question, doesn't it? What's the long-term potential for robotics to truly transform field service in these, challenging and remote energy environments?
It's a huge question. And similarly, they're committed to aggressively investing in AI for productivity improvements, again, building on that crucial foundation of standard work.
And all this is backed by continued investment in R&D, $0.3 billion in Q2, and capital expenditures, $0.2 billion in Q2.
Yeah, to drive those breakthrough energy transition technologies and expand capacity, they're clearly planting seeds for future growth.
So given the strong performance, the strategic clarity, it's no surprise they've confidently revised their 2025 guidance upwards.
Right. They're now trending towards the higher end of that $36–37 billion revenue range for the full year.
And a pretty significant profitability upgrade, too. Adjusted EBITDA margin now expected to be 8–9%.
Yeah, raised from their previous forecast of high single digits. Plus, their free cash flow guidance got a big boost, increased by about $1 billion.
Wow. Now expected to be $3.5 billion. That's a substantial increase.
It is. And it's important to note that this upgraded guidance fully embeds the estimated impact of those tariffs we mentioned, the $300–400 million hit for 2025.
But that's trending lower now.
Importantly, yes, it's trending towards the lower end of their initial projection, which suggests their new contracting and sourcing strategies for the future are already starting to yield results.
Okay, and segment-wise, what are the key adjustments?
Power revenue growth is up to 6–7%, and its EBITDA margin to 14–15%. Electrification revenue growth gets boosted significantly to 20%, and its EBITDA margin to 13–15%.
Huge jump for electrification.
Massive. Wind revenue is still projected to be down mid-single digits for the year, but losses are trending toward the lower end of what they expected. And crucially, they have an expectation to approach break-even in the second half of 2025.
That would be a critical turnaround point for wind.
Absolutely. And they also mentioned the typical fourth quarter weighting for adjusted EBITDA just due to services, seasonality in power, and that sequential growth building up in electrification.
Okay, so to kind of wrap things up.
To summarize, yeah, GE Vernova delivered genuinely strong Q2 results. They're clearly seeing accelerating growth opportunities across their segments, making smart strategic investments in innovation efficiency.
And it's all leading to a significantly strengthened financial outlook.
Exactly. They appear to be navigating this whole energy transition with both agility and a clear long-term vision.
So what does this all mean for you, the listener, as you think about the future of energy? As global electrification and decarbonization just keep accelerating, maybe consider this.
Yeah.
What unexpected roles might mature technologies like gas power, like those synchronous condensers we talked about, play alongside emerging innovations like SMRs and grid AI?
In shaping a truly resilient and sustainable energy future.
Exactly. It's a complex puzzle, no doubt. But GE Vernova's quarter gives us some pretty compelling pieces to consider.